In September 2019, something unusual happened deep inside Wall Street. Overnight lending rates, normally around 2%, suddenly spiked to nearly 10% as banks stopped lending to each other. For a brief moment, the financial system froze. The problem wasn't panic, it was liquidity. Corporate tax payments and treasury settlements drained reserves. At the same time, the Federal Reserve was shrinking its balance sheet. Bank reserves fell below the level needed to keep short-term funding flowing. Within hours, the Fed stepped in, injecting billions into the system through massive repo operations. By October, daily injections reached $120 billion. Quietly, without headlines or fanfare, the Fed reignited the liquidity machine. Reversing months of quantitative tightening, the markets responded immediately. Stocks surged to record highs, bond yields fell, gold and silver began to rally, and cryptocurrencies woke up from their long bear market. I recognized what was happening and positioned myself accordingly. I bought Bitcoin at around $5,000, Ethereum near $90, XRP at 0.13, Cardano at 0.03, VeChain under a penny, gold around 1,400, and silver near $13. It wasn't luck. It was understanding how liquidity flows. When central banks turn on the spigot, money searches for yield. And that wave pushes into everything: stocks, metals, and digital assets. By early 2020, before COVID-19 even hit, those positions were already moving. When the pandemic triggered another historic round of monetary expansion, every asset surged. Now, in October 2025, the pattern is repeating. Banks are once again turning to the Fed's emergency facilities, with borrowing from the standing repo facility, hitting the largest levels outside quarter-end periods. Overnight repo rates have risen, and large treasury settlements, $40 billion one day, $23 billion the next, are draining cash from the system. Analysts are noting signs that liquidity is tightening, reminiscent of the 2019 repo crisis. The Fed's balance sheet, which has shrunk from $9 trillion to $6.6 trillion since the post-pandemic peak, may soon stop shrinking entirely, as Chair Jerome Powell signals a potential end to quantitative tightening. The conditions are lining up for another wave that could lift markets across the board, just as it did in 2019. And what am I doing this time? Exactly what I did then, positioning early before everyone else sees the wave coming. Consider this a record of my observations, an insight into what's unfolding, so that when history repeats itself, no one can say they weren't informed. Disclaimer: this content is for informational and educational purposes only.